Goldman Sachs, for example, is projecting that by 2075, India's economy will surpass the US, second to only China in its size overall in GDP. Your projection is actually a little bit more aggressive than that.
The main difference between the Goldman Sachs prediction or the Ernst & Young prediction vis-a-vis mine is essentially, them not taking into account these important macroeconomic developments that have happened in India over the last few years. India's GDP in 2047 is likely to be closer to my prediction than theirs.
It's projected that India will surpass the US economy in size, but when exactly will this happen? And what does this mean for the world economy once India becomes a large economy, surpassing a global superpower in size and scale? We'll talk about this with the next guest, Krishnamurthy Subramanian. He is the executive director for India, Bangladesh, Sri Lanka, and Bhutan at the International Monetary Fund, IMF, and he was a former chief economic advisor to the government of India. He's the author of India at 100, Envision Tomorrow's Powerhouse, which is coming out later this summer. And in this book, he outlines in great detail his projections for Indian growth and how the economy will grow and what people can expect from this growth. Welcome to the show, Professor Subramanian. Pleasure to host you. Honored to have you here today.
My pleasure, David.
I want to talk first about the election that had just happened. The Indian viewers, first on their minds, what does this mean for the economy? So Modi was reelected. I'd like to ask you about what this reelection means for the growth prospects, and more specifically, the Make in India policy that was enacted a few years ago that's ongoing. What does this mean for the manufacturing sector and growth overall?
Lots of questions there. So let me start first, David. For me, the recent election means continuity. The government led by the Honorable Prime Minister Narendra Modi has come back in power. It is part of a coalition now. The party that the Prime Minister heads has 240 seats, and there are 30 odd seats that are being, that other coalition partners, and actually about 290 odd, with the majority mark being 272. So it's a coalition government, but if you look at the portfolio of ministers, the cabinet, it is a continuity, because the same, if you look at the major portfolios, finance, defense, home, external affairs or foreign ministry, the same, those who had the responsibility in the second term are the ones that are continuing. So I expect more continuity, and that is good news, because India grew at 8.2% in the last year. That was the GDP growth rate in real terms. And amidst a global economy that is not being able to grow very fast, I think this is excellent growth. In fact, India has emerged out of COVID, as I had predicted in September of 2021, in that India will grow at 7% plus, coming out of COVID. That's exactly what has happened. 9.2% in the year immediately after COVID, 7% after that, and then 8.2% now. So overall, I think the macro performance has been good. This also combines with inflation that has been very moderate amidst a period, when the Ukraine war had led to supply-side frictions, supply-side problems, and therefore advanced economies faced anywhere between 2.5 to 4 times the historical average inflation. India's inflation was less than its historical average. So overall, I think the macro fundamentals have been excellent, and growth has been very, very, noteworthy.
I was informed that the markets were expecting a BJP majority government. That didn't happen. The Indian stock market fell, I believe, 6% on the day the elections were announced. Can you comment as to why?
So I think you're right that the market was factoring in the party ruled by the party that was the ruling party getting a majority. That did not happen, and so there was some uncertainty as a result of that. And I think the market fell. But it's important that since then, markets have more than corrected, and the government has come back, to power. Some commentators, if you look at especially those based here in the United States and the rest of the world, have commented that this is actually even better, because we have a government that is known for its economic policy and is governing the economy very well. together with a strong opposition. So in some sense, they've called it a win-win.
Well, why is it that the markets initially priced in, I suppose, an expectation for better economic performance if it were a majority government versus what it actually happened?
No, I don't think it was relating to the economy because you have to keep in mind that any uncertainty does affect the stock market. And there's in fact, for instance, work by Nick Bloom and others at Stanford and Chicago showing that political uncertainty also has an impact on asset prices. So it was the expectation of the market, especially because the exit polls, all the exit polls had predicted a majority for the ruling party, and some of them had predicted an overwhelming majority. So the market had factored in that aspect, and so the uncertainty, with the outcome being different from what the exit polls predicted, I think created some uncertainty only on the day of the elections. But since then, as I said, they're more than corrected.
Professor Subramanian, tell us about the Make in India policy. In your evaluation, how effective it's become or has been. Now, some current news: Apple plans or intends to manufacture, I'm reading, a quarter of its iPhones in India over the next 2 to 3 years. So tell us about this policy and how it's attracting foreign companies to manufacturing in India.
That's a good question, David. You will have to allow me to give you a little bit of background on this. In 1991, India liberalized its product markets, and so foreign companies could, come and, do business in India. You would remember that pre-1991, India was a socialist economy, mostly a closed economy. But when it comes to the markets for factors of production, be it land, labor, capital, power sector, which is basically a very important input for manufacturing, logistics, which are transportation, or even scale economies, which actually reduce average costs for firms. These factors of production, the markets have not been reformed. If they continued to be distorted up until 2014. And in fact, the reason India did not benefit from manufacturing, especially before the global financial crisis, when China and other countries were growing their manufacturing sector significantly, from tailwinds for global trade, in that India did not benefit as much because these factor markets were not reformed. So it's been a policy failure up until 2014 primarily, which led to India's manufacturing not being, not growing well enough. So it is in that backdrop that we have to see the launch of the Make in India campaign by the current government. So now some of these factors of production have been reformed. The impetus on infrastructure, especially on roads and railways, that's been a big push. Even during the time when I was in the government, this was something that has been really focused on. You would notice, post-COVID capital expenditure has been ramped up significantly, especially contributing to, the infrastructure. So as a result, logistics costs have gone down. The power, sector has actually been reformed to some extent, but there's more work to be done. So power has become far more reliable. Ports, for instance, some of the bottlenecks there have been removed. These are all parts of logistics and power. And the capital, the market for capitals, the banking sector has been reformed significantly. So, in 2018, when I became the chief economic advisor, the financial sector was facing a lot of, headwinds from dual balance sheet problem, very lot of non-performing assets. That's been reformed significantly. Now, both the corporates and the banks have become quite healthy. Together with that, some of the reforms that actually have been done, which need to be completed, labor market reforms. The Indian labor market continue to be very distorted, and the bill has been passed, and subordinate legislation needs to be passed. So when you put all this together, there's been a lot of groundwork that has been done, which has led to manufacturing sector growth. As you rightly said, Apple has set up shop. Currently about 14% of the iPhones that are manufactured by Apple are manufactured in India. And a good part of that is basically should grow significantly. As you said, about quarter of the production of iPhones of Apple should be in India in the near future. So this is the backdrop. I think the Make in India campaign is doing well, but there's still a lot more work to be done. Especially, I would emphasize, the markets for land. Land states need to work on this to produce land banks that can be given for setting up huge factories. So that's one area that needs emphasis. As I said, the others have been focused on. The labor reforms, I'm hoping that in the government that has come into power now will actually issue the subordinate legislation, thereby bringing the regulations into play. So overall, I think this is something that has been seen good progress, but more to come. I will also comment on one important initiative that the government launched, and this was when I was part of the government, the production linked incentive scheme, which gave incentives for companies like Apple to set up shop, and because there is some some incorrect commentary that is there oftentimes on the production linked incentives. I want to give you the correct numbers on this. About 44 billion rupees have been disbursed as part of the production linked incentives, and this has led to about 1 trillion rupees of investment, and which has in turn actually led to 7 trillion of production and 700,000 jobs. If you just take Apple, about 150,000 jobs have been created by Apple. And if you take Apple suppliers, they've created about 80,000 jobs. Now, do keep in mind that this outlay for the production linked incentives is a one-time outlay, which will lead to a lot of profits and wages collectively in the future. So overall, when you put all this together, I think Indian manufacturing sector looks poised for very good growth in the future.
Is the objective of the Make in India plan to produce these goods for domestic Indian consumption or to become a global manufacturing hub for foreign companies?
So it's both. You have to remember that, like China, India has a very large domestic market,
Yes.
iPhones and overall smartphone consumption, by not just the middle class, but even the lower middle class is very large. At the same time, if you look at in the last year, about 4 trillion rupees of mobile phones were produced in India, of which 1.2 trillion was exported. So about 30% was exported. So it is both for domestic production and also for for exports. So overall, you have to keep in mind that if we look at the example of the automobile sector, the automobile sector, the Japanese company Suzuki set up shop in India in the late 80s, and at that time it was only being assembled. Cars were being just assembled in India. Later, over time, the entire ancillary sector grew, and now the Indian automobile sector actually has a very large, the entire supply chain has built up. In a similar way, I expect electronics manufacturing, the supply chain to also get built up. Right now, it's more assembly of these mobile phones, but they will get manufactured. So you have many other companies actually setting up shop as well. So this is an area that should see very good growth.
Well, this is good for the manufacturing sector of India, but I think the Indian viewers watching this, they're wondering how exactly will Prime Minister Modi's policies increase or improve the standard of living for the average class or middle class or even lower class going forward?
So that's a good question. I have, I'll cover two key areas on this. One, if we look at, India, as I said, I expect India to grow at least at 7% in real terms, in its GDP. If you look at population growth over the next, in the future, maybe a decade or 2 decades, population growth is likely to be about 1%. So if you take 7% as the GDP growth and 1% population growth, that translates into GDP per capita growth of about 6%. Now, you use the rule of 72, which most of us use for finding out how many years it takes to double the money. So in about a decade, slightly more than a decade, one would expect GDP per capita to double. So in the next 30 years, 3 decades, that will mean about 3 doublings approximately. So one can expect GDP per capita at this rate of growth to multiply about 7 to 8 times in the next 2 to 3 decades. Now, the second aspect that I want to get into, because you also asked about what will it mean for the lower middle class and the poor and the vulnerable. Here's where India's growth, I think, has opened a new leaf starting post 2014, because the welfare programs have been far better directed. One of the aspects that India has really leapfrogged compared to all other peer economies and advanced economies is the digital infrastructure. Early in 2000, early in the first term of this government, about 550 million bank accounts were created. So let me just let that number to sink in. That's about 1.5 times the population of the United States. And over 500 million of these bank accounts are active. And using these bank accounts and using the digital identity that has been created, money goes directly into the bank accounts of the poor and the vulnerable. Just to give you one example, during COVID, and I was part of the government at that time, in the United States, checks were printed, checks had to be signed, they had to be put into envelopes, then sent to the US Post Office. People got those checks, went to the ATM counters, deposited their checks, and then withdrew their money. 6-7 steps, which we basically did it through just the click of one button. And in seconds, actually, cash reached the the poor and the vulnerable, and well directed. We didn't give cash to everybody. People like you and me, we are well off. We didn't deserve to get cash, and so we didn't spend like a spendthrift. Instead, targeted it very well and did it very soon. So that's the kind of digital infrastructure that has been created. As a result, more than or about 4 trillion rupees of savings have been generated over the last 10 years, because earlier there used to be a lot of pilferage in the welfare programs. Now, through the use of the digital infrastructure, pilferage has been reduced significantly, which has resulted in such large savings. So going forward, because of this infrastructure, and here a key aspect that must be remembered is that India has created the digital infrastructure as a public good. If you look at every other country, it is the private sector that creates the digital infrastructure. Because the sovereign has created this digital infrastructure, access is almost universal, and as a result, the poor and the vulnerable have also gotten access to this. For instance, in India, if you go, you want to drink a cup of coffee, you can actually go and just pay using, pull out your phone and pay. In fact, there were videos of some of the heads of state that visited New Delhi, going and drinking tea or coffee with the prime minister and paying using their their mobile phones. So this is one area which will lead to growth being far more inclusive, and thereby a creation of a large middle class, in the last, in the next 2 to 3 decades. So overall, as I said, growth will lead to, maybe 7 to 8 times increase in GDP per capita over the next 3 decades, and this growth is likely to be inclusive, creating a large middle class.
Okay, I think now is a good time to segue into your forecast for the growth overall of India. There's been a lot of forecasts made by big banks, big think tanks all around the world as to where the Indian economy will be in the coming decades. Goldman Sachs, for example, is projecting that by 2075, India's economy will surpass the US, second to only China in its size overall in GDP. Your projection is actually a little bit more aggressive than that. You're saying in your book, India at 100, you envision that India can maintain 8% annual growth until 2047, making India $55 trillion economy by 2047, which actually is much bigger than Goldman Sachs forecast by that year. Can you elaborate on the differences?
Yes, I'm glad you spoke about this. So let me use another prediction that has been made by a global consulting firm, Ernst& Young.
Yeah.
And the reason I'm using that is because both my prediction and the Ernst & Young prediction is for 2047. The Goldman Sachs prediction that you mentioned is for 2075. That's about 3 decades after 2047. So Ernst & Young predicts India's economy to be 26 trillion in 2047. So let me take you through the economics of the prediction that I have vis-a-vis that of the Ernst & Young. So if you take, so I'm going to do a little bit of mental arithmetic now, and I'm sure your viewers are very smart people who can actually stay with me on this. So if you take real growth to be 7%, and inflation to be 5%, which is what has been the case from 2017 onwards, 16, 17 onwards in India. So add the real growth and inflation, you get nominal growth in rupee terms at 7 plus 5, which is 12%. Now, when you have to predict in dollar terms, you have to take into account the depreciation of the rupee vis-a-vis the dollar. Historically, if you look at from 1991 onwards, and that is a break because that's when India liberalized its economy, so we can look at that period, the rate of depreciation of the rupee vis-a-vis the dollar has been between 3 to 3.5% per annum on average. So let's take 3%, and because depreciation of the rupee, subtracts from the value in dollars, right? So 12% in nominal rupee terms with 3% depreciation translates into 12 minus 3. That's 9% in dollar terms. Now, once again, let's use the rule of 72. So at 9% growth in dollar terms, in 24 years, from 2023 to 2047, that's a 24-year period. So there are 3 8-year periods, and let's use the rule of 72, as I said. If dollar growth is 9%, rule of 72, 9 times 8 is 72. So in 8 years, GDP will double. And as I said, over a 24-year period from 2023 to 2047, there are basically 3 doublings, right? 8 years, 8 times 3 is 24. So in India's GDP in dollar terms in 2023 was 3.25 trillion. So 3 doublings means from 3.25 to 6.5. That's the first doubling. 6.5 to 13, that's the second doubling. And 13 to 26 is the third doubling. So you can see how, the Ernst & Young prediction of 26 trillion comes about. You basically need 3 assumptions there: 7% growth in real terms, 5% inflation, and rate of depreciation that is same as has been historically the case of 3%. Now, here's where my assessment differs from that of Ernst & Young. India's historical inflation has been more than 7%. So this rate of depreciation of more than 3% has prevailed during a time when the rate of inflation has been more than 7%. But since 2016, when India implemented the inflation targeting regime for the central bank, inflation has come down significantly. In fact, inflation from 2016 onwards has been 5%. So that's more than 2% less inflation, compared to the past. So now, again, market participants and economists would agree that the currency which has actually a higher rate of inflation has to depreciate more for the real value to remain the same. So, when you take that concept and implement it in this particular setting, 2% decrease in inflation will mean 2% lower depreciation. Not just that, the productivity growth has also been significantly higher. From 2014 onwards, the Penn World Tables data, if you look at the productivity growth from 2002 to 2013 for India was 1.3% per annum, but from 2014 onwards, it is 2.7% per annum. So it's, more than double, which will translate into higher per capita GDP growth and thereby lead to real appreciation as well. So when you put these two together, you can basically see that, and that's the prediction in my book, that the rate of depreciation of the rupee vis-a-vis the dollar, actually will be different from what has been historically the case because of lower inflation and because of higher productivity growth. So in the rate of depreciation will be between 0.5% to 1%. Now let's use that and redo the math. So 8% growth, as I mentioned earlier, and you preambled in your question, 8% real growth, 5% inflation. That's 8 plus 5, 13% in nominal rupee terms. Let's take 1% depreciation, even though the actual prediction in my book is 0.5%. Let's round it off, 1% depreciation. So what does that translate into dollar terms? 13 minus 1, which is 12%. So 12%, annual growth in dollar terms. Again, let's use the rule of 72. 12 times 6 is 72. So GDP doubles every 6 years. Over the 24-year period from 2023 to 2047, that's 4 doublings, not 3, because 6 times 4 is 24, right? So let's do the math again. From, as I said, in 2023, the GDP was 3.25 trillion. So 3.25 to 6.5, that's the first doubling. 6.5 to 13, that's the second doubling. 13 to 26 is the third doubling, and 26 to 52 is the final doubling. So that gets you close to the mark. I actually did some ballpark estimates here. 52 versus my actual prediction is 55 trillion. So to let me put all this together. So the main difference between the Goldman Sachs prediction or the Ernst & Young prediction vis-a-vis mine is essentially, them not taking into account these important macroeconomic developments that have happened in India over the last few years, that impacting the rate of depreciation of the rupee vis-a-vis the dollar. They're assuming it to be the same as has been historically the case, but fundamentals eventually do work in markets, and therefore the lower rate of depreciation will prevail. And therefore, I actually think that based on international economic theory and concepts, I think that India's GDP in 2047 is likely to be closer to my prediction than theirs.
But Professor Subramanian, why are we using the assumption that the growth rate, the annual growth rate, will be consistent at 8% until 2047? Shouldn't the first derivative fall down the closer the country gets to full maturity? I mean, if you take a look at all the advanced economies around the world, at some point they were high single-digit growth, if not double-digit growth. They've all come down to low single-digit growth. As India becomes a world power, shouldn't the growth rate be closer to a G7 country?
That's a good question, and I cover this extensively in the book because this is something that definitely will be anticipated. So I'll give you two responses to this. Let's first look at China. If you look at China around 2007, China's per capita GDP was about the same as India's, about close to $3,200, $3,300. And if you look at the growth that China has had post 2007, and that includes the period of the global financial crisis, so global demand coming down, average growth has been close to 8% in China. So that's the first. And I'll bring this together, why the comparison with China is better. Now, you mentioned about advanced economies. See, here's where it is important to understand the important differences, salient differences between advanced economies versus economies like India and China. Advanced economies, almost the entire economy is formalized, and therefore growth has to happen only through productivity growth in the formal sector firms. In contrast, if you take India, estimates for the because that is something that because data is not as easily available, but anywhere between 2/3 to 3/4 of the Indian economy is still informal. Now, so the first driver of growth will be formalization of the economy, and very well, David, macroeconomist. Actually, our viewers will also understand that informal sector firms are far less productive than formal sector firms. So the formalization of the economy itself will drive growth. That's the first driver. Second, even if you look at the formal sector firms, compared to the firms in the formal sector firms in the G7 economies, Indian firms actually are far behind the cutting edge at this point in time. So through innovation and entrepreneurship, they will also grow their productivity. That's a second margin that will contribute to growth. Third, which is mechanical, is, it goes back to the first driver I spoke about. Currently, because the 2/3 to 3/4 of the economy is informal, that is not counted as part of, GDP, because informal sector activity doesn't get fully counted. When formalization happens, just mechanically, that will also add, because it'll get counted. Final bit, which is important to keep in mind, is that, if you look at the way the entrepreneurship is growing in India, for instance, now India has the third largest ecosystem for startups in the world. Over the last 10 years, the CAGR for startups has been 220%. In India, startups have grown at 220%. And now they're solving many of the problems that India faces. And you know very well that startups are actually, they lead to creative destruction, and thereby also push the incumbent firms to innovate. So that will lead to, a lot of productivity improvements as well, which is why I think, till the Indian economy becomes completely formalized, much like the advanced economies, the comparison to advanced economies is actually fraught with peril. And that's why one has to be careful to understand the nuances and the differences about the Indian economy. And allow me to actually say this, that having been part of the government when the COVID economic policy was implemented, it is this kind of understanding of the differences of the Indian economy vis-a-vis the advanced economies, which is what led us to actually implement economic policy that was different from the advanced economies. We, for instance, did not do a spend like there's no tomorrow. We did a balance of supply and demand side measures, and as I was mentioning earlier, that the proof of the pudding is in the eating. That has led to wonderful growth with moderate inflation and very good macro fundamentals. So that illustrates how nuanced understanding of the Indian economy is important to be able to actually assess its growth prospects.
Okay, well, allow me to please present to you challenges to growth. A few of them I'd like you to address, please. The first one is a potential brain drain problem. Now, you're aware that the net migration to India is currently negative, which means more people leaving the country than going in. In fact, many high-skilled workers are going into the West, the U.S., for example. Let's just take a look at some of the biggest U.S. tech companies: Alphabet, Microsoft, IBM, Adobe. All these CEOs are Indian. And so if you consider that many of the smartest Indians are moving to the West, if you were still at the government, if you're still chief economic advisor, what would you advise Prime Minister Modi to do to A, attract high-skilled labor into India, and B, prevent high-skilled labor from leaving India?
So I'm glad you asked this question. So let me give you some historical context here. So I graduated from the Indian Institute of Technology in 1994. When I look at my batchmates, those that about, I would say, anywhere between 3/4 to 80% of my batchmates have migrated to the United States. In contrast, if you see today, if you look at the graduates that come out of the IITs, in India today, that proportion would be about 20%. In other words, 80% was migrating to the US, in 30 years back. Today, it's only 20%. Why do I point this out? I point this out because India has grown at more than 7% during a period of such large brain drain, where 80% of some of the best talent actually migrated to the to the United States. In contrast, in the next 25, 30 years, as the opportunities grow, and this has already happened, why is it that today only 20% of IITians actually migrate to the United States? Because opportunities in India are far better than they were in the early 1990s. So the better economic opportunities, in and itself will significantly reduce brain drain. And let me explain this here. So if you look at overall salary growth in any economy, typically a good ballpark is that it should grow at the rate of at least the nominal rate of growth of the economy. If you take the United States, 2% real growth and maybe 2% inflation, nominal rate of growth will be about 4%, which means salaries will double in about again using the rule of 72, it'll double in anywhere between 18 to 19 years, right? In contrast, at the rate of growth that I actually mentioned, in rupee terms, India's rate of growth is likely to be about 12%, which means that salaries will double in about 6 to 7 years. So during the 18 years that it takes for salaries to double in the United States, there would have been 3 doublings in India, which means salaries would have increased 7 or 8 times. So this is something that smart people will factor in and say, even though I might be earning less in dollar terms today if I'm in the Indian economy, by the time I'm finished with my career, I might possibly be earning far more than my counterparts who actually decide to migrate to the United States. So as a result, both these phenomena will ensure that brain drain will be much lower. Now,
yes.
The second aspect, I think, which is very important, I have seen a big difference, in India in the kind of talent even compared to my generation. So if you look at my generation vis-a-vis the previous generation used to be far too apologetic about India. They used to actually look at the West with almost rose-tinted eyes and saying everything about the West is great. My generation is not as enamored. Actually, we understand the strengths that the Indian economy has far better. The generation that is coming after me is even more confident about India's prospects, and these will be people who will actually go and create entrepreneurial firms, because entrepreneurs have to be confident about their abilities. So the generation that is coming after me is even better than our generation. So overall, I think, and with a large population of 1.4 billion, even with the brain drain, there will still be absolutely adequate talent to actually fund, and to generate growth. Look, if you look at unicorns in India, unicorns have actually grown at such large numbers, right? Now there are more than 100 unicorns in India, and some of them actually will become decacorns as well. So I think, given our large population and given the talent, the cream of talent that we have, even with the brain drain, we will continue to have enough talent to actually generate that 8% growth.
Okay, the second challenge I want to pose to you is the gender imbalance. So currently, according to the World Bank, 52% of the total population is male. Does this present a challenge to household formation, population growth, and perhaps even some speculate civil unrest or productivity decline?
So let me, take that point on civil unrest right away. This is oftentimes actually a sort of a advanced economy prism that is used to talk about, in terms of, and I can speak definitely as an Indian. I think Indians are far more resilient. So, even if you take a period like COVID, or some of the restrictions that were imposed actually were taken very well by the population. So civil unrest is something that actually I will keep off the table. Let me come to but the question that you asked about female labor force participation is pertinent, and let me answer that. So if you look at the labor force participation rate, and I'm using data from the NSSO, the National Sample Survey Organization. In 2018, the female labor force participation rate was 23%. In 2023, in just 5 years, that has increased 37%. So from 23% to 37%. And some of these actually are because of the policies that are being implemented. So the government is absolutely cognizant of the need for half of the population to actually be participating in the in the labor force, and therefore labor force participation is increasing, partly also because of the policies that have been implemented. For instance, the emphasis on toilets, because in rural India and for the poor, it's women had to actually go and for their morning ablutions they would have to walk before sunset, but so the creation of toilets has helped them. Secondly, the provision of gas cylinders. So earlier women would have to actually cook with much unhygienic means, and it would take a long time as well, but gas cylinders have actually reduced their
Should this come from the public sector,
and also
should this come from the public sector, the building of infrastructure like toilets, for example? Should this be a government initiative, or should the private sector be investing in this?
It is actually, this has already happened. I'm not talking about what stuff to happen. This is the sanitation. Actually, it's been done by the government, by the public sector.
Okay.
Look, as an economist, actually, we have to understand that public good provision, is the private sector doesn't do it. So it is the government that has done it. In fact, this has been a big campaign that has happened. As a result, women can now, go through their morning ablutions at home rather than having to go, into the fields, which was what was the case 10 years back. Secondly, as I said, women have been given gas cylinders to cook, so that has actually enhanced their productivity. They spend less time cooking, and that has led to more time for women, which has actually enhanced their participation in the labor market. So overall, incentives like these and policy measures that will focus on the women will enable more participation of the women. So I think these are challenges that the government is absolutely cognizant about. I will, you haven't asked me this, but I will mention climate change is a challenge that we also have to, talk about. And I think I cover that in the book in great detail. At the same time, also political uncertainty, if at all, there may be, we've had stability for the last 10 years, and going forward for the next 5 years, I expect stability as well. But some political instability might actually generate some of the not so optimistic outcomes. So in the book, I actually cover different scenarios, and if, for instance, some of these risk factors do manifest, growth will not be 8%, maybe 6%, and in which case the economy will actually be about 26 to 27 trillion, not the 55 trillion.
Okay. And finally, I want to talk about the sector composition of the Indian GDP and how that will perhaps change in the future, perhaps not, according to your estimates. Currently, I'm looking at the breakdown. Roughly 28% of the GDP is industry, 55% is services, 18% agriculture. How do you expect this to change? And second part of the question, which sectors of the economy do you see the most potential for job growth, job opportunities for young Indians?
So first, I expect manufacturing to increase significantly. So I would think that manufacturing would be, could be about 25% from about, 18% now to about 25% of GDP. Agriculture should reduce concomitantly as more jobs are created in manufacturing, and some of those who are currently in agriculture should then move into manufacturing for the jobs that will be created in manufacturing. And that is why one of the key areas, as we spoke about this earlier, the Make in India campaign has been launched because the recognition is that manufacturing sector growth is really critical for job creation in the Indian economy. Now, when it comes to sectors, and if you're thinking about this from the perspective of stock market returns, maybe stock markets, investments for investors or other asset markets. I want to actually, I will talk about some of the sectors that may be attractive, but I think it is important for me to point out that when foreign investors think about investing in a country like India, they do take into account the rate of depreciation of the rupee vis-a-vis the dollar, because they are eventually looking at dollar returns. And here, I think it is quite important. I circle back to some of the commentary I gave you earlier on the rupee depreciation vis-a-vis the dollar. The fact that inflation has come down, as a result, depreciation of the rupee should be lower. So foreign investors should keep in mind that the 3 to 3.5% depreciation of the rupee, which actually meant that if you were earning X% in rupee terms, in dollar terms, you were earning X minus 3 or X minus 3.5, that will be a thing of the past because of the macro developments. Quite likely the rate of depreciation of the rupee will be about 1%. So if, for instance, in rupee terms, the Indian economy, grows at 12% or 13%, then dollar returns are likely to be about 12%. And I think I have no hesitation in saying that in the current environment, in the next 20 to 30 years, dollar returns exceeding 10%, in such a large economy like India, I think that's an unprecedented opportunity for global investors. Now, when it comes to some of the sectors that may be attractive, I think manufacturing sectors that actually use manufacturing, will be ones that will definitely, attractive. At the same time, the growth of the Indian economy will lead to a large middle class being created, and as a result, some of the consumption, especially fast moving consumer goods, and other durable goods, etc. in consumption, those sectors will also be very attractive. So these might be the sectors that investors can think about. But overall, I think even if, let's say, they were to invest in the index, because of the average growth rate of the economy in dollar terms itself being high, I think investors can make very, very handsome returns.
We only have a few minutes left. So final question, Professor Subramanian, thank you very much for your time. Do you think the Indian rupee should be a free float going forward? Will it change to a free float from a managed float right now?
So you're actually talking about, potential capital account convertibility, and some of the related aspects. So I actually think that India will be moving towards more and more convertibility of the rupee, but it'll be a slow process. But wearing my hat as a director at the International Monetary Fund, I also want to learn from the previous experiences, especially the Asian financial crisis, to suggest that India will move towards capital account convertibility, but not complete convertibility. In other words, it'll get there, but be almost there without fully becoming convertible because of some of the risks of capital flight that we've learned from episodes like the Asian financial crisis.
Last summer, during the BRICS summit in South Africa, the Indian foreign minister said, quote unquote,
on what we will discuss at the BRICS meeting, that we'll have to see, because there are many other issues, but there's no idea of a BRICS currency, if I understood your point rightly, that currencies, to my mind, will remain very much a national issue for a long time to come.
This has been echoed by several times by Indian ministers. Why not? why are we not taking why is the Indian government not taking the position that there will be a common currency between other BRICS nations, de-dollarized, so to speak?
See, this entire debate on de-dollarization is, I think, it has picked up, but we have to keep in mind that at this point in time, the dollar, does benefit from the TINA factor. There is no other alternative. And I think, to your question about the BRICS currency, there are, a lot of geopolitical aspects also that go into it. I'm not an expert on those
Sure.
factors. So, I'm happy to talk about the economics, but because this is determined significantly by the geopolitical factors, I don't have the expertise to comment on it.
Well, I appreciate you commenting on the things that you do have expertise on. That was a very thorough discussion. Thank you very much, Professor Subramanian. Where can we follow you in your work? I mentioned you have a book upcoming in the next couple of months. Where else?
Well, I actually am a financial economist and I'm an academic. So research is something that I enjoy. My work going forward will be focused a lot in India. When I was a chief economic advisor, I used to actually find that high quality empirical work, especially on or even theoretical work, on macroeconomic and monetary economic, aspects, is not very high in India. For instance, I would oftentimes sort of envy my counterpart in the United States, the CEA, the Council of Economic Advisors. On any issue, if he wanted to actually be to sort of think about policy, he could pick up at least 4 or 5 high quality papers and use those research papers to guide his thinking about what policy to implement. In contrast, as the chief economic advisor, oftentimes I had to actually fly blind because I wouldn't find very high quality work on some of the critical issues in macroeconomics or monetary economics, and that's an area that gap is something that I would love to fill. My previous book, Money, a Zero-Sum Game, got into some of the key aspects of monetary economics because I find that some of the monetary theory, that economics pontificates is too ivory towerish, and it doesn't take into account the realities, and the theory itself in many places is wrong. So that's the kind of work that I anticipate doing going forward. Hopefully, leave a legacy of work on macroeconomics, monetary economics, and overall the economy, the Indian economy that future generations can refer to and benefit from.
I appreciate your time once again, Professor Subramanian. I hope to see you again soon and update us more on the Indian economy and other areas of your work. Thank you.
My pleasure, David.
Thank you for watching. Don't forget to like and subscribe.